Everybody's talking about how cheap PayPal stock is, so we're going to pick up from where we left off 18 months ago and take a look at PayPal. We're going to identify key metrics to watch for investors, and we're going to explain why the stock languishes today. So PayPal really needs no introduction. I think the key takeaway here would be their market share leadership. So they have about a 41% market share for online payment processing technologies. That's as of the end of last year. So when we look at pieces that we've written, we often compare PayPal to firms such as Adyen or Square. And our most recent piece in June of 2022 asked the question here. It says, PayPal stock plummets. Is it a good buy? Well, it's plummeted a further 20% since we wrote that piece, and our premium subscribers said they wanted an update. So where did we last leave PayPal? Well, we noted that they were trading at a relative bargain, relative the key word there, compared to what they had been trading at. And since that piece in June 2022, they're down a further 20%, while the NASDAQ is up 35%. So relative to an appropriate benchmark, which would be the NASDAQ, which they trade on, it's definitely not living up to investors' expectations. And we had said here that the growth story is hard to read through the fog of the post-pandemic economy, and more importantly here, the opaque reporting structure. So at that time, PayPal said they saw a $110 trillion opportunity with plans to hit $50 billion in revenues by 2025. Well, that's next year. And right now they're about $29 billion. They'll realize that in 2023. So if we had more color around their large catch-all reporting segment, we might be able to deduce how they ever planned to get there. It certainly doesn't seem like they'll get there today. When we look at revenue growth, it's clear that it's stalling. So you can see that double-digit growth, 2019, 2020, and 2021. So the strong growth through that time frame would be the Rona. And then more recently, in 2022 and 2023, they're down to single-digit growth. And when you look at the stock price performance, you can see here a chart that's reminiscent of a Zoom or any other firm that seemed to have what we've coined the Rona effect, where everything got pumped up based on strong growth that they were seeing. And of course, that didn't last forever. So if we look at PayPal's performance since their most recent IPO in 2015, it's up 90% versus the NASDAQ at 209%. So it's certainly underperforming its benchmark. And the question is, there value to be had there? Now, one measure, a key metric for PayPal, which is becoming less relevant, is this active accounts metric you see here, and we've taken that all the way back to 2018. You can see how growth in terms of active accounts on their platform, and one problem with that term is that it refers to merchant accounts and consumer accounts. So 8.2% of these over 400 million accounts are merchant accounts, around 35 million. 40% are international accounts. So it'd be very useful if they broke out merchants versus consumers, but we're left with this. Here they say on last quarter's drop, so this metric has now plateaued and last quarter dropped. They said this drop referred to churn of minimally engaged accounts, so people not using the platform, fair enough, and the strategic decision to focus on driving higher activity levels with existing active accounts, what they refer to as land and expand. So is that because now it's becoming too expensive to try to get new accounts? Hard to say, but this metric becomes a lot less relevant. So really, we're left watching to hope that it doesn't go further to the downside and that it maintains a plateau if they've indeed made the strategic decision to focus on these existing accounts. So what happens when you start selling to larger enterprises, which is what they're likely doing here with Braintree, we'll talk about that in a second, but that usually means pricing concessions at scale. And that is obvious in another metric that we're going to look at. But Investor Place, I think, says here something that succinctly sums up the whole thing. It says, PayPal branded checkout. So at Nanalyze, if you go to purchase a Nanalyze subscription, PayPal is an option. So 80% of top retailers in 2022 use PayPal. Everybody does. Why? Because customers feel a lot better about using PayPal to pay for something than giving up their credit card. So you can have your credit card in one place and simply make a PayPal payment. That's why we enabled it, because so many people asked for that. So they say here that PayPal's branded checkout offering, which pretty much everybody uses, faces slowing growth. Meanwhile, Braintree, an unbranded checkout for merchants, so that's sort of a white label behind-the-scenes offering, that's surged with a 40% increase in total payment volume in 2022. It now constitutes, or at least then it did, 30% of PayPal's overall total payment volume, and they should break that down in their decks, which you need to really scour for such information. But the takeaway here is that this is lowering their margins and pressuring their overall profitability. And we can see that by looking at two more metrics, payment volume and take rate. So let's start with payment volume, what you see here. Does that black line there in the chart on the left look familiar? That's their growth, and that sort of mimics that share price, right? When everything was rosy in the times of the Rona and they were just growing like mad and they were going to hit $50 billion next year. Well, that just didn't happen. You can see that growth crater there. And total payment volume, if that's growing at least at a decent clip, 20% you can see last quarter, then how come revenues aren't growing that fast? Well, the percentage of money that they are able to capture from that payment volume is referred to as take rate. So if your take rate stays the same, you're always capturing the same percentage. But if it's going down, that's a problem. And it is going down. And before we look at that, take a look at here, the metric on the right, which shows, remember those active accounts staying stable around 400 million? Well, the transactions per account are going up. Again, the old land and expand. Now, even though payment volume is going up, look at their declining take rate. This is what that investor place piece referred to, the declining margin. So the percentage of money that they're able to take from that volume is declining over time. So those two are offsetting each other, and you're getting that slowing revenue growth. And what I like about these two numbers, it makes it very easy to resolve it to revenue. So simply take your take rate times the total payment volume, and that's your revenues for the quarter. You see, we've done that there at the bottom for the last quarter, which had $7.4 billion. So growth is slowing, and another side effect of that would be capital allocation. So this is a very good slide from their last quarterly deck, which shows in yellow there the acquisitions and strategic investments that they've been making over the years since they had their IPO. You see those more or less dried up in 2023 year to date, slowed down a lot in 2022. Share repurchases have replaced those. So they've generated $31 billion in free cash flow since becoming an independent company in July of 2015. From that money, they used $21 billion to repurchase shares. Now, that's a good idea now. Maybe that wasn't such a good idea when their share price was at an all-time high, and it's good that they weren't purchasing that many shares around that time. But they also used $13 billion for acquisitions and strategic investments. So when a firm doesn't have a lot of opportunity to grow internally or through acquisition, then all the cash flow they're generating, it only makes sense to give it back to shareholders in the form of a dividend or repurchasing shares. You want them to repurchase shares when they're cheap, which is presumably now. Another couple things that we noted on here, the credit receivables sale to KKR, so that's good. They're getting rid of some of their consumer debt exposure. And then they announced the divestiture of Happy Endings for $465 million. So that's one of their acquisitions. They've made quite a few. Some have been good, some haven't. And they in reference to that, said that it's enabling greater focus on the core business and strategic priorities. So they're sort of saying, all right, we got a little too out of hand with all the $13 billion in acquisitions, which, by the way, left $12 billion in goodwill on their balance sheet. Now they're sort of reining that in, seeing what they actually have. Now, when we look at the repurchasing of shares, I like these two charts because they show the exact same thing, but the y-axis has changed. So on the left there, it looks rather dramatic. On the right is more accurate of the real numbers. So all those share purchases have resulted in a 10% decline in the number of shares outstanding over the past decade. So it's a lot less than it might feel when you look at the chart on the left, which actually is useful in showing the acceleration of those share buybacks this year with the share price being presumably depressed. That's good. That's when you want them buying back shares. But the key takeaway here is that even with all that buying back, hasn't moved the needle that much. So takeaways so far. The rampant acquisitions that they did weren't always money well spent. Now, if they used overpriced shares to make those acquisitions, then that wasn't necessarily a bad thing. But that, of course, has left $12 billion in goodwill on the balance sheet, which can result in write-offs. Now, buying back shares means there's no better use of capital to grow, though when shares are depressed, that's a good thing. But are these shares really depressed, or are they just reflecting the transitional valuation of a value company, not a growth company? And that comes to PayPal's problem that we believe it's transitioning from a growth company to a value company. You can't look backwards at previously hyped shares and expect the current share price to revert back to that mean. Value the company today based on their prospects today. Now, you could certainly argue it's undervalued by looking at the NASDAQ as a benchmark, but then ask yourself, does the potential upside offset the possible downsides? Now, investors all seem to be waiting for some rebound. PayPal stock sucks. Just remember, you need to invest in companies, not stocks. Pay a lot less attention to what the stock is doing and more attention to what the company is doing in terms of their ability to continue growing. Now, sales growth for value companies, we wanted to touch on that. Now, when you think about a company that's selling something and year over year, what they can do to increase sales is increase their prices to match inflation. So you should expect any company selling a widget to increase sales by 3.3% every year. That's average inflation. So even if they're not selling more to existing customers or new customers, they're still able to increase revenues 3.3%. Then take into account stock market growth, which over time is 6.6% minus inflation. So we can therefore presume that companies should grow at least 3.3% based on price increases, and therefore somewhere between that number and 10% would be expected sales growth for value companies. When it comes to growth companies, then single-digit growth, 9%, that would be the bottom rung. You would expect them to grow much more than that. They're growth companies after all. So the key characteristic of a value company is when they switch from focusing on revenue growth to earnings growth. And PayPal these days is looking like a lot less of a growth company and much more of a value company these days. That reflects the current share price, so it's sort of adjusting for those new expectations. Now, when it comes to the key metrics to watch, again, payment volume, so any sort of macroeconomic headwinds could create problems for PayPal. So that's something you need to be aware of. The pros there, of course, more transactions and volume could happen using PayPal, and as long as their take rate stabilizes or even starts to increase again, then maybe they can see growth. But there's always going to be downwards pressure on pricing when you start selling more to existing customers. So they need to think about more creative ways to capture value from the 32 million merchants on their platform. Other value adds mentioned that we came across cross-border transfers. There's a lot of competition there. I think that's probably the topic of another piece when we look at firms like TransferWise and whatnot. There's Crapto, so they're coming out with a stable coin that's said to offer some value. We would definitely need more color in terms of revenue segmentation to understand what value that they're getting from these different components. There's buy now, pay later. We don't want any part of that. It was good to see them selling some of that exposure off their books to KKR. Now, PayPal's old investor decks did a lot better job of breaking this stuff down. Lately, they're very difficult to navigate and try to extract information aside from this large bucket that they throw all their revenues into. So I'm going to go ahead and put up another video here. We've talked today a lot about growth versus value, and this piece here we did is very good in describing how investment professionals segment growth versus value. So I'll leave that for you to watch. Please subscribe to this channel. Thanks so much for taking the time to watch this today.